Welcome to Markets Now. I'm Michelle Rook along with Jim McCormick with agmarket.net. And we are mixed to lower over in the livestock futures here this morning. The grain trade is lower in corn and wheat right now. Soybeans trying to hold on to some gains. Jim, I got to ask you about this corn market. We've taken out the March lows now in both July and December contracts. Talk about the fund liquidation that we've seen and what could reverse this.
Right now, the funds just are getting out of it, Michelle. I mean, the reality is we're not competitively priced on the export side of the equation. You're pricing corn out against Brazil. No one's going to buy our corn, so the market is trying to find a little bit of value. The ethanol industry is running okay, but it's not enough to make up for that export. And, planting progress has definitely been delayed as a whole in the northern part of the country. But, kind of where I'm at, stuff is starting to break free a little bit. The weather is going to moderate next week. So I think the market is just continuing to search for demand at the moment. The fund position, we got to be a little bit leery about it. They're only long 40, 50,000 contracts as of the last CFTC report. And if you look historically, the funds are not afraid to go short corn into the springtime if we're off to a good planting pace. So it's something that we need to get something exciting about this market to get the funds to essentially quit wanting to liquidate and actually come back into the market.
Right. And the funds have been liquidating. They had a longer position in the soybeans. They've been liquidating that. We're seeing maybe a little bit of corrective buying here at times this morning, but I guess I'm curious about demand being the story there. That's the other thing that the funds have been watching in that market, especially with Brazil's price so much lower than ours, right?
Exactly, Michelle. You nailed it. Brazil's selling beans $100 a ton cheaper than us. We are just not competitively priced on the export market. We may get a little fill-in business here and there due to quick ship stuff. Every once in a while, China will come in and buy from us simply for the reserves, simply because we have better quality beans at store. But now you got a problem even on the exports, not just for beans, but and corn as well, as you've got flooding in the northern part of the Mississippi River. So a lot of that product's not going to be able to make it down to the Gulf, and that'll make our product a little bit more expensive, potentially keeping us even further away from being competitively priced. So right now on the demand side of the equation, unfortunately, it looks like it's got to be done on the domestic side. And I just don't know if there's enough excitement on the domestic side to really get this thing to turn on the demand side, which means I think if we're really going to get this market to change, Michelle, either it's going to have to be a weather concern or potentially maybe the wild card could be some news coming out of the Black Sea region where Putin actually does shut down the grain corridor as he keeps threatening to do.
Yeah, we'll talk about that in a moment when we get into the wheat discussion here. But I'm curious about soybeans because soybean meal is hitting 4-month lows here. That's probably a function of the Brazil competition that we just talked about. But what are you watching there? And if we, continue to slide in soybean meal, what does that mean for price projections for soybeans?
Right now, I mean, this $430 level on the meal has been kind of some pretty good support in this zone for the last, 4 or 5 months. We take that out. You could argue you got a head and shoulder formation forming, and that would project that meal market closer down to the 380, 375 level, potentially down there. Plain and simple, we're not competitively priced, and the demand's just not there for it. The meal goes down and the oil goes down. Unfortunately, it's probably going to pull the beans down. Crude oil market did fill its gap that it left when the Saudis surprised the world and said they're going to pull back on oil production. But that rally did not last. If the crude oil is weakening, that hurts the demand for biodiesel or for any kind of energy. So right now, the demand is definitely the concern for all the markets.
And today we're seeing a little maybe meal oil spread unwinding, why meal is lower and oil is higher. Because I know yesterday oil maybe saw some pressure here just because of this debt ceiling talk and maybe removing these biodiesel or renewable diesel tax credits. And now that's off the table.
Well, right now, no, I think it is on the table. I think right now the market's just, yesterday said the oil is down, meal is up, unwinding the spread. I think you were right. The market is concerned about it. The Republican proposal is to cut a lot of those taxes and subsidies that really are keeping their biodiesel, renewable diesel plants, build out going. My guess is, Michelle, that is not going to go anywhere for Biden. It's going to be a no-go. But it is a concern for the industry, like I said, because, what makes that industry go is the tax subsidies. So if they would strip that out, or for some reason that does get involved in a final budget deal, that would be negative potentially for renewable diesel growth, and that would be negative for demand for beans, plain and simple.
You bet. Okay, so wheat market has been under pressure. HRW has been trading the potential rainfall that's coming. Actually, we had some rainfall that came overnight. Do we have that all priced into the market, or do you think we have much lower to go in that market?
I'm hopeful that we're getting close to putting a bottom in that market, Michelle. I think a lot of this rain has been talked about. We're down a little bit on that news today, but we're off the lows as we record. So hopefully it's dialed in. The reality in the wheat, a lot of our clients are saying it's raining where there's no longer wheat. A lot of this wheat in the western part of Kansas was ripped up. It died from all the wind and everything else, lack of moisture. They tore it up and they're planting beans or something else in it right now. So I think this wheat crop is going to get smaller, and that should get the market's attention down the line, I believe. I think the next thing the wheat market, and potentially the corn market's really going to look at is this Black Sea grain corridor, as I mentioned earlier. Putin's threatening to shut it down, and that could be a game changer if he would do it.
Yeah, let's talk about that. How much credence do you give to those threats from Russia?
All right, now, Michelle, the market's kind of shrugging its shoulders at it. I mean, he's threatened to do it multiple times. I think he's now become the guy who cries wolf. He keeps threatening to do it, but nothing happens. So the market is just not believing it. If you look at the price of wheat, we're trading wheat cheaper now than we were the day the war started. And if you look at corn, where the July corn's trading at, we're pretty much trading where it was the night the war started. So I would argue there's very little quote unquote war premium in the market. But sometimes I think you gotta be a little bit cautious. Sometimes people will tell you what they're going to do and you need to believe them. And right now, Putin is really ratcheting up the rhetoric. The G7 is threatening to shut down all exports except for like medical needs and maybe food to Russia. And if they would do that, I think there's a legit probability that Putin may actually step in and shut that grain corridor down. And if he would do that, I think that would result in a dramatic repricing of both corn and wheat. Ukraine roughly exports about 7% of the world's wheat supply and about 14.5% of the world's corn supply. So if you would take that supply off the market for even a little bit of time, the world end users are going to have to find different suppliers, and that different supplier potentially could be the U.S.
Plus, on top of that, the funds are over 100,000 contracts short in Chicago wheat, and they're not very long in corn right now either, are they?
Exactly. So if you gave the funds a reason to get out, I mean, that's the best thing to get this market to rally, is it's going to be the funds. The funds drove the prices up to those extreme levels we saw last year when the war began. Right now, they're short this wheat. It's a pretty, but if you would shock the market and they would get forced out, you could see a pretty violent reaction to the upside. So it's something we need to keep an eye on. That grain corridor shutdown date at this point, technically, is May 18th. So that's kind of the mark you should put on your calendar.
All right, as we talked, Jim, we have the cattle market under a little pressure. We've been consolidating since we put those record highs in here a couple of weeks ago. Some saying that is a blow off top. So do you agree with that? And is there a lot of downside risk here with the funds as long as they are yet, and the fact that we have potentially some risk off news coming here, including the Fed announcement this next week?
I think there is a potential that you did put a blow off top in, Michelle. I mean, the reality is the cattle market is driving on what? It's driven on the tight supply. Everybody knows that. The Cattle on Feed report confirmed it. Now what we're worried about is demand at this point in time. You do have the Fed raising rates more like a quarter point. That is what everyone's assuming. But I think that's kind of the minor risk at the moment. The longer term risk that's going to come up in the month of May is this debt ceiling negotiations that is going on right now. The House Republicans and President Biden are miles apart. I believe they're probably going to go to the brink, unfortunately. And if they go to the brink, that's probably going to unnerve the stock market, kind of like how the stock market was unnerved, Michelle, when we had that banking crisis a few weeks back. And when the stock market broke, the cattle market broke. So if we saw the consumer sentiments already kind of weakening, we get some weakness in the stock market or equities in general as people worry about the U.S. defaulting on its debt for the first time ever. I think that could spill into the cattle market, and it could go lower than people think is possible just on the exodus of the funds, because they are carrying a pretty big they are carrying a pretty big amount of contracts. So if they chose to get out and go to flat, it could cause a pretty hard slide.
Yeah, I think there are over 100,000 contracts along there. Okay, conversely, they're short, record short in the hog market. So if you do have a debt ceiling default or discussion here, does that negatively impact hogs, or do they go the opposite direction?
I think in general it could be a little bit more positive. I mean, the reality is people get unnerved about their economic situation. They tend to try to save money. Pork is really, really cheap. So I think that could drive some demand to the pork market. And the other thing, I think, Michelle, is you mentioned it. The funds are long cattle. They're short hogs. And when there's a time of uncertainty, what a lot of these funds do is they don't go to a different position. They tend to go to cash. And cash right now isn't exactly a worst thing you can do. Remember, Apple's giving you 4.15% on your money. So even Apple's giving you some pretty good returns. So I think, if you would see a mass exodus of the funds out of the long cattle position, that may be enough to chase them out of the short hog position. And, since you see the spread between those two narrow up.
Yeah. Until that happens, though, we still got to get this cash market to bottom in the hogs, don't we?
Exactly. I mean, that's probably the biggest problem the market's looking at is the cash market. If the cash market would bottom, hopefully we can get this thing to go. Technically, we had a nice reversal on Friday. The market's trying to bottom off on that reversal. I don't think we've accelerated out of it enough yet to say that bottom's in, but it's something, showing a little bit of positive sign with that reversal on Friday.
All right. Thanks for joining us, Jim McCormick with agmarket.net, and that is Markets Now.